Well, I can't speak for the banking sector at large. I think there's a broader question around is upcoming regulation and continued pressure on return on equity on bank balance sheets appropriately priced into what we're seeing in the market currently. So to come back to the comments made earlier, I do think borrowers have clearly a premium for whole loans. People want to have a solution for their financing requirement. If alternative lenders can provide that, great. If banks are needed to hold and syndicate, then clearly this needs to fit into their criteria with return on equity and the overall regulatory requirements. And I see a number of questions. AQR is one of those on the horizon. And personally, I'm not convinced that all of this coming down the road for the next 3 to 5 years is necessarily reflected in current liquidity and pricing. From an investor perspective, I do think there's continued relative value on James' remarks earlier, because clearly pricing has tightened in the sector, but the next best alternative for many fixed income investors has been government bond investing, and real estate debt continues to provide a significant premium. So I'd say that's something to keep in mind when we're discussing pricing and various market participants and their approach to it.
If you dig into what AQR is really about, it's more about deleveraging banks' balance sheets. And the process to date, I think, across both the UK and Europe has not gone as fast as maybe many of the central banks would have liked. If you look at the recently published De Montfort study in the UK, the amount of deleveraging or reduction in balance sheet loan lending that the banks have achieved is short of what was expected over the previous 4 years or so. And I think what makes that very interesting in itself is that, and I think it's the comment Paul made a little earlier, the market has come up, it's taken out a lot of troubled loans, and therefore the deleveraging process has really been substituted by the market seeing out the loans themselves. So I think the extend and pretend process has actually continued quietly in the background when deleveraging is what really AQR was meant to be about. If you compare the UK, what they called the slotting regulations, and what's happened there, the Bank of England ultimately, or the Prudential Conduct Association, or the PCA, has actually agreed with each bank a separate or individual glide path, as they call it. And I think that's quite a subtle term to be used, but a glide path means that each bank has its own timetable and its own degree by which it's meant to achieve compliance with these regulations. And I think what AQR is going to have to do under the European model is look at how they can achieve this equivalence to the glide path. And the reason that's going to be important is if you do a one-size-fits-all across all of the European economies and European banks, it's going to create quite a hiatus in terms of how the banks are going to achieve compliance with that and how they're going to then, if they have to, continue deleveraging their balance sheet. Because what that can ultimately result in is a further flood of assets, be they loan assets or indeed underlying property assets, into the market, which in terms of the property markets themselves could actually have quite a significant impact on what is currently a sort of fairly firmly established recovery process.